we come to the use of funds of the last APO, right?
Yes.
The company has disclosed that $6 billion went to alternative investment strategies. In the recently released prospectus, $4 billion is earmarked for similar strategies, right? Continued alternative investing. So that's $10 billion. So can you give us some color on what was acquired and what is intended? Some details on the intended continued alternative investment.
Okay, thanks for that question, Raul. And let me just back up by saying that the fact is that Barita is committed to continuing to participate in the usual traditional tradable securities, stocks, bonds, whether it's emerging market bonds, local stocks, etc. That will continue as Barita's position improves and grows. And that's important to state. The fact is that many of those traditional investments are really well funded through short-term interest-bearing liabilities. Many of us know them as repos, and that will continue. If you look at the year-over-year position of Barita, you'll see that interest-bearing liabilities, I think, has grown to support the traditional part of the business, largely led by trading. The fact, though, is that there is a structural shift that has been happening in the market locally and in many other economies in the Caribbean, but Jamaica is leading it, where the fiscal dynamics have really settled down, where we've gone through an extended period of low interest rates, and that's not by accident. The government of Jamaica, and this has been a common thread of the last several years of our history, has been exercising serious fiscal austerity, and our key debt ratios as a country have been significantly reduced. What it means is that the appetite of the government of Jamaica is now much more reduced to be coming to the market for additional debt, and therefore the interest rate that the government has to pay has been low and is likely to remain low. Now, within that context, continuing to build a business solely or primarily based on investing in government debt and funding it with short-term liabilities is really not sustainable to continue to generate differentiated value and optimizing value for shareholders, and also achieving all of the big, broad, ultimate objectives I've mentioned earlier. So the fact is that Barita, while continuing to grow that business, is now focusing on other lanes of opportunities. Our global view is that high beta assets, and many of those are the traditional assets, emerging market bonds, traditional stocks, etc. Those high beta assets are now at very high valuations relative to recent history, and we're in the middle of a pandemic. So just focusing on I'm just focusing on our investment thesis here. At the end of the day, it makes sense acting responsibly from a capital allocation point of view to be shifting some of those funds towards lower beta opportunities. And we're seeing significant lower beta opportunities in the alternative investment space. It's a different asset profile. We think that the right way to fund that asset profile principally is through long-term financing. And we have done that in the 9-month period. You mentioned that we have invested roughly $6 billion already in this space, and really outside of just the narrow investment thesis, making sure that we're protecting our market risk, which will translate to our fair value position in our balance sheet should there be any shocks to current valuations in global markets. What we want to ensure is that we're properly enabled to support the productive sector. And in supporting the productive sector, what is very important, and most investment bankers and bankers will see it, is that you're not just in a position to be providing traditional senior type secured facilities to support that sector, but you have to be doing certain private credit type transactions and private equity to support emerging businesses. In fact, there are many established businesses who sometimes need certain facilities in order to go into newer lanes of opportunities to expand their existing platforms. And so what we're doing is having holistic conversations with our clients and ensuring that we are capable and executing as it relates to these non-traditional opportunities. So if you ask me what we have done with the money, we're looking at private credit, private equity, we're looking at infrastructure, real estate, energy, and the funds that would have been deployed over the 9 months. If you look at the 13.5 billion raised, the deployment of the funds over that 9-month period would have intersected quite a bit with those various lanes, sub-lanes of alternative investment opportunities that we have executed on and we continue to pursue.
So does that strategy bring Barita closer to the real economy?
That's the objective. That's the objective. That's very important. And if your funding profile and funding structure is right, it's going to give you the capability to offer the solutions needed for that sector. That's correct. And as Ramon said earlier, most of these are private transactions. Many persons know about the public transaction we have done, which is Ramon, and that's a real show of supporting the productive sector and capacity of the country. But there are many other private transactions we have done and we are doing.
And would it be fair to say that strategy widens the opportunity set in terms of funding for your average Jamaican or regional private business?
That's correct. And ultimately, we cannot lose sight of the ultimate goal. To the extent the average business is getting greater lanes of opportunities for funding and different solution suite, then they are better enabled to grow their base and grow the economy.
Exactly. Okay, sounds good. Ramon, along similar lines.
Yes.
In the last APO, it was communicated that Barita wanted about $1.8 billion to seed new managed funds.
Yes.
Right. In this APO, I think the number that's being communicated is $4 billion.
Yes.
That's $5.8 billion. But investors have no identifiable new managed funds to evaluate Barita's performance. Can you provide some color and some detail on that?
Sure. So, I mean, there is an intersection between, as Jason pointed out, our investment view principally and the investment view that we want to bring to our clients to offer to them for participation, right? Consequent to that fact, the new fund opportunities that we're pursuing are along similar lines, right? And I can speak publicly, we are well progressed in bringing those alternative type investable opportunities to our customers, right? In various ways, right? So for the institutional customer, there may be an opportunity that is more similar to a co-investing type of structure. And for the retail customers, we will naturally have to present them with a platform that's flexible, that allows them to invest at a smaller scale, and we are well progressed in doing that. Now, the activity that Jason mentioned that we are focusing on as a principal investor is not separate and apart from what we will ultimately present to our clients, right? The fact is that there are many investments in the alternative space that require some post-investment development, so to speak. So let's think about real estate. I mean, you may make an investment in a plot of land that requires a whole bunch of work to make it developable, right? And essentially what we are trying to do as an investment bank is really to return to the roots of financial services, which is to intermediate, which is to deploy capital, right? To transform assets and to represent them as investable opportunities on the side of providing investment solutions. And similarly, on the funding end, as Jason said, we want to have sufficient flexibility to provide funding solutions that match up with where a business is in its life cycle, for example, with the nuances of a project that a business may want to pursue that doesn't quite match up with, traditional lanes of funding. So that's really it. So we are intermediating at the moment. We are preparing both the vehicles that our investors will be participating in, and also the seed assets in relation to said vehicles.
I don't know. It sounds to me like you're preparing another great deal for retail investors.
Well, we definitely aim to please.
I learn in your style. So Jason, the interest rates are at record lows. Why not raise debt capital as opposed to yet another APO?
Well, I mean, if you thanks for that, Raul. If you look at Barita's numbers, Barita is generally increasing its exposure to interest-bearing liabilities. Since this fiscal year, interest-bearing liabilities has grown by over $10 billion. So we're not ignoring that opportunity to fund and grow the business. But I think, as I mentioned earlier, that type of funding complements very well the traditional lanes of the business, led by trading, and a lot of our trading activity is funded by a higher mix of debt funding relative to equity funding. But the other lanes of opportunity we're moving in to include investment banking, alternative investments, certain bespoke asset management services which need to be seeded. The seeding of those opportunities that Ramon spoke about are best funded with longer term permanent capital. So it's not that we're saying no to interest bearing liabilities. They're continuing to grow, but in terms of having the right mix to ensure that we're in a strong position as a business, and the shareholder can be protected not just in the normal times, but in really bad times. And we went through the crisis, and we're still going through it. And as a business, Barita is in a very strong position, both from a capital ratio point of view. Barita has the strongest capital to risk-weighted assets ratio in the industry, and it's not. I don't say that to boast, but it's important. It's probably the singular key measure of the strength and safety of an institution, and that didn't happen by accident. It's because of our deliberate strategy and execution, flawless execution of that strategy, to ensure that as we grow and as we add assets to the balance sheet, we're ensuring that we have the right balance of interest-bearing funding for those assets with permanent capital. We have been relentless at that, and I think the shareholders and customers in Barita ultimately have benefited from that and continue to benefit.
Well, if I could just add to that, I mean, you also have to look in the context of the market structure, right? So Jason spoke about long-term capital as being best for funding these opportunities, and it's true. And maybe if we're operating in North America, we could launch a 30-year bond and get funded at 2%, right? But if you look at the context of the Jamaican market, that type of funding isn't necessarily available for financial services type companies. So what we've opted to do is fund the business responsibly, right? So to break it down to maybe a personal circumstance, you wouldn't quite fund the purchase of a home with a credit card, right? You want a 30-year long-term mortgage to pay down against an asset of that size and scale. And it's similar. The projects that we're looking at, as Jason used the term intergenerational. Some of them, won't quite span several generations, but certainly they force us as an investor to be in a position to take a longer term view, right? Especially when you start thinking about things that impact the real sector. When you start thinking about core infrastructure, you need the flexibility to be able to remain invested in those opportunities for a while. So that's why we've opted to go for the best type of long-term funding there is, which is permanent funding, equity.
Absolutely.